Okay, welcome to the next session on commodity derivatives and risk management. If you recall, we started discussing what are the major factors which influence the crude oil price. As I see it, identifying all factors is almost next to impossible, because you never know what is happening, where is having a impact on crude oil price. So it is very extremely difficult if somebody says that I know exactly what factors influence the crude oil price. But sitting today, we are going to be discussing what are the major factors which have bearing on crude oil price. The discussion probably today will be hovering around the factors which is influencing WTI crude. The same factors is also applicable for same factors also influence the other crude oils, which are crude variety oils which are produced all over the world. If you recall, we were discussing last class in this particular slide, and we started with the discussion on the happening of geopolitical events and its influence on crude oil. And as I mentioned, if you recall in the last session, that during September 2011, the crude oil price, the WTI crude oil price, was quoting at $25 discount to the Brent price. So there could not be any reason other than 9/11 affecting the price of WTI vis-a-vis the North Sea Brent crude oil. So other geopolitical events has always influenced crude oil price. So crude oil price is extremely sensitive to whatever is happening at major crude oil producing nations, as well as the geopolitical activities at major crude oil consuming nations. So the next one is the supply demand situation. We also discussed about the financialization of crude oil through the trading of derivatives contracts, and how it is influencing the crude oil prices. In fact, crude oil is one of the largest crude oil has the maximum amount of derivatives trading done by non commercial producers and consumers. So many hedge funds, banks, financial institutions, investors, speculators who have nothing to do with this particular commodity per se, they have entered into futures and options contract for making some profit. Another factor which influences the crude oil price is the US dollar index. So US dollar index has a negative relationship with the crude oil price. So let's understand what is US dollar index. It's an index which measures the value of US dollar relative to some major currencies, and this index has the value of 100 and the base year is 1973. And when US dollar strengthens, this index increases, and whenever this index increases, crude oil price goes down. And this particular picture which you are seeing, this is a relationship between US dollar index and WTI spot price. And though it is not mentioned here, the correlation between US dollar index and WTI spot price during January 2000 to January 2013, during these 13 years, hovered around negative 0.88. So where I got this particular picture, in fact, one thing I would like to share with you all today, that I have written a book on commodity derivatives and risk management, and this particular book is published by PHI Learnings, and in fact, my interest for commodity derivatives developed when, as a teacher of a subject titled Financial Institution and Markets, I realized that not much of a material is available in the academic domain with respect to commodity derivatives, even though we have 2-3 multi-level commodity exchanges, and a lot of trading volume every day, a lot of discussion, debate happens in financial newspapers, but not many B schools are offering this one as a specific subject. So that is where I started learning little more on commodity derivative, and this book was published in the year 2014. And today when I was pasting this particular picture from the book, all of a sudden I realized that even if I have recorded almost more than 50% of this lecture series, I have not even once mentioned about this book to you all. And so I thought this is the time I should inform you all. And this book covers almost all commodities which I am going to discuss during this 40 sessions of lecture. And of course what I am going to tell is that as academicians we are not very good at branding ourselves, so please don't take it as a exercise to make my book popular, so that the book sells. Of course I'll be very happy if somebody takes it that way, and because every time a book sells I get some royalty. Of course the royalty, if I can say it in a financial terms, or is peanuts. But nevertheless, when a book sells, I feel good, because I feel that when somebody is buying that book, I'm sure he or she is going to read the book and get some, be more knowledgeable on commodity derivatives market. Okay, with this, okay, and this, when now I'm talking about the book, one thing I would like to quote here. One of my colleague had mentioned once to me that in India you write book for the love of writing the book, not for making money, because simple economics comes into play. If the photocopying expenses are even marginally lower than the book cost, people will photocopy. Please don't start discussing about copyright violations and all that, because this is not a forum for this discussion. So we know, and everybody knows, people do photocopy books, if not the whole book, at least a major portion of the books are photocopied. So let's go with the status quo and not debate or discuss whether it should be done or whether it should not be done. So now continuing with our discussion on what are the factors which influence the crude oil price. So as I mentioned, US dollar index is a significant factor which influences the crude oil price. So whenever US dollar index goes up, US dollar WTI crude price goes down, and both exhibit a negative correlation. And like any commodity, the available inventory at a given point of time is also has an influence on the spot price. If inventory is substantially high, or currently the more amount of inventory is available for crude oil, it will have an impact on the crude oil price. Now when we are discussing about all these factors like supply, demand, financialization, where do, if somebody wants to know more about crude oil, so which are the authentic sources of information from which he or she will be able to make out or find out good authentic information regarding the crude oil market. So this is, of course, this is a OPEC website. I just want you all to be aware of a monthly bulletin which is published by OPEC, and this is the list of monthly bulletins, and something interesting also is available. If you see this drop down list, if it is visible to all of you, I hope it is visible to you. Yes, I have increased this. If you see this one, this is your OPEC basket price, taxes on oil, OPEC upstream investment, OPEC downstream investment, OPEC oil reserves, OPEC market indicators, historical production data. So this is one authentic source, very reliable authentic source of getting to know what is happening in the in terms of production and in terms of new investment, exploration activity in the major crude producing nations. Another authentic source is your US Government Energy Information Administration website. You also have Reuters, Bloomberg and Platts and Argus, etc., providing many discussions, many analysis about future direction of crude oil prices. So you can access to some of these websites and start in spending some time to learn what are the more major factors which influences the crude oil price. Now let's go to, we'll discuss now what are the how these companies which are exposed to variation in crude oil prices and variation in refined product prices, how do they mitigate their risk? Of course, many of these companies enter into OTC contracts, so we'll go and discuss these OTC contracts in detail, but we'll also spend some time understanding various exchange traded derivative contracts. So now let's start with this is a link, Chicago Mercantile Exchange. So in this Chicago Mercantile Exchange, you have under the energy products, you will be able to see hundreds of derivative contracts which are listed. So I have just downloaded those. So I hope you are able to see, and let me increase the font size. So this is the this particular link shows, I have just only downloaded the available contract. So you have crude oil options, you have crude oil futures, you have WTI crude oil 1 month calendar spread option. I mean, it is mind boggling, it's unbelievable the number of contracts, the variety of contracts which are available for trading at Chicago Mercantile Exchange. Normally we understand when we talk about derivative contracts, the people who are starting with understanding derivative contracts, they predominantly think derivative contracts is related to futures or options or at best spread contracts. But if you could I will just scroll through. If you see this particular link, crude oil has 183 different types of crude oil derivative contracts, and there's like you have crude oil calendar strip options. I mean, the list is endless, so I'm not going to spend more time on it. And if you are interested to learn more about these different varieties, you have to spend considerable amount of time downloading the contract specification, and who could be the user of this contract depending upon their commercial operations. So this is your crude oil contract. Now let's go to the refined product contract. So again, if I let me make it bigger, if you see, these are your NY Harbor futures contract. This is gasoline contract. So again, this is in around how many? This is even more than that. So this is coming to around 416 contracts. So the last one is Gulf Coast ULSD Argus up down futures. So if you are more interested, please go to the CME website. So what I am discussing today is that I'm just giving you a touch and feel of what are the different varieties or types of options of derivative contracts which are available for trading in organized exchanges. So under the natural gas, you have 298 contracts. Of course, all these contracts may not be trading with equal liquidity. So some contracts may be trading more. Yes, this is again petrochemical futures and option contract, different combination of it. You have propane, ethane, butane, and there are different kinds of petrochemical contracts available. So this link, this particular Excel file, please note that I am not going to upload it. It will be, I'll be providing you link in the PPT file, and you please visit the CME exchange and go to the energy product, and you'll get to know the number of different types of these derivative contracts. And if any specific contract you would like to know more about, you have to go and download the contract specification, and each derivative contract also has certain information pertaining to it available at the CME website, and you can read more to understand more about that particular derivative contract. Now let's go to understand a little more on the futures contract which is on crude oil traded at CME. So please see this one. This is your crude oil future contract specification. Contract unit is 1000 barrel. And this is what I would like all of you to, let's spend some time. I hope it is visible to you. This one, the listed contract. So what are the listed contracts available? So if I can read out, crude oil futures contracts are listed 9 years forward using the following listing schedule. Consecutive months are listed for the current year and the next 5 years. In addition, June and December contract months are listed beyond the 6th year. So additional months will be added on annual basis after the December contract expires, so that an additional June and December contract would be added 9 years forward, and consecutive months in the 6th calendar year will be filled in. So going by that, let's understand how exactly. So we are currently under June 2016. In fact, to be precise, today is 24th June 2016. Okay, before I go into this, I want you to focus a little bit on this particular detail, that is a termination of trading. So when trading for a given month ends, so trading in the current delivery month shall cease on the 3rd business day prior to the 25th calendar day of the month preceding the delivery month. So let me repeat, trading in the current delivery month shall cease on 3rd business day prior to the 25th calendar day of the month preceding the delivery month. With this, let's start to understand more on the contract details. So we are, as I mentioned, we are on 24th June 2016 today. So which will be the contract available? July contract, 2016 contract will not be available, because this July to 2016 contract will be expiring on 21st June 2016. So July to 2016 contract will not be available, but which contract will be available? August 2016 contract. So September 2016, October, November, December 2016 contract will be available. And what will be available? We will have similarly January 2017 contract will be available, will be December 2017 contract. Similarly, you will have all monthly contracts up to next 5 years. So we will have a 17, 18, 2018 contracts, all serial months 18 contracts, 2019 contracts, so 2020, 2021. So all serial month contracts for January to December will be available. And also, if you recall, subsequent to this we will have only June and December contracts will be available. So beyond December 2021 we will have June 2022 contract and December 2022 contract, June 2023 contract, December 2023 contract. So yes, so we'll have December will be added 9 years, so you'll have June 2024 contract and December 2024 contract. So at a given point of time, this many contracts will be available for, this many futures contract will be available for trading to a trader. Of course, if there is not buying and selling interest, some contracts may not trade. So we'll take the data, the real real life data, real data which was I have downloaded from the Bloomberg database to find out what is the commodity forward curve for the crude oil. That means how does this different contracts, futures price of different contracts are compared to each other. Of course, this is something which I thought of sharing with you. Who is the delivery procedure? Delivery procedure is at the buyer's option, and where the delivery will happen. The delivery will be, if you see this one, this part, the delivery shall be made free on board at any pipeline or storage facility in Cushing, Oklahoma, with pipeline access to Enterprise Cushing storage or Enbridge Cushing storage. So the seller has to deliver the crude oil at Cushing warehouses. And which is the delivery option? It is the buyer's option. So if the buyer wants to take delivery, the seller has to deliver the underlying crude oil at this designated delivery location, that which is Cushing, Oklahoma. Other details are there. I am not going into it. We have already discussed this aspect in the earlier sessions. Now let's go to future contract specification at MCX. Of course, what is a trading unit? You have 1000 barrel, and one thing I would like to share with you, where is the delivery? If some buyers and sellers are interested to, if some buyer is interested to take delivery, where he will take delivery of the underlying crude oil, and it is at port installation at Mumbai JNPT, Jawaharlal Nehru Port Trust Port. So at this location the seller has to deliver the crude oil. And what is the quality specification? Quality specification is light sweet crude oil conforming to the API gravity between 37 degree to 42 degree and sulfur of 0.42%. And also another aspect which I want all of you to focus on, what is the due date rate or the price which will be considered for settlement of the contract on the contract expiry date. So that is due date rate is the Indian rupee value of New York Mercantile Exchange crude oil front month contract multiplied by the RBI USD INR reference rate. So the price prevailing WTI futures crude oil futures contract at NYMEX into NYMEX front month contract. So the price prevailing of NYMEX crude oil front month contract on the last trading day of the MCX crude oil contract into the RBI multiplied by USD INR exchange rate as given by the RBI. So that is going to be the due date rate. And who has a delivery option? Delivery option is both option. That is buyer seller options are going to be matched, and accordingly the delivery will be done. And let's go to the contract launch calendar. So today we are on 24th June. So which are the contracts which will be available? If you see, I will be able to take I'll not be able to take June 2016 contract because this June 2016 contract has expired on 20th June. So I can take July 2016 contract, August, September, October, November and December. Yes, December contracts is available to me because this contract started on 21st June. Considering the fact that we are today on 24th June, so a trader will be able to buy or sell futures contract on July, August, September, October, November, December. So when we compare the available futures contract to be traded in Indian exchanges, if you can see, compare that one with the CME or NYMEX contract, it is much lesser in duration. In fact, only 6 months, up to a period of 6 months into the future, a trader in India will be able to take exposure, while in case of a CME crude oil futures contract, it can go up to maximum 9 years period. So with this, I would like to end our discussion on what factors discussion on today's session. We'll continue with remaining part of the crude oil in the next session. So to summarize what we discussed today, we discussed what factors influence the crude oil price, and we also briefly discussed about my book and the third part which we discussed is the variety of derivative contracts which are available at Chicago Mercantile Exchange for crude oil and all other derivative products from the crude oil, that is heating oil contracts, gasoline contracts, diesel contracts, petrochemical contracts. And we also understood the contract specification of crude oil futures contract available at CME and multi-commodity exchange respectively. So this session comes to an end. We'll continue with understanding about the futures price prevailing at CME in our next session. Thank you all of you.